Welcome to the IRS Solution Attorney Show. If you have problems with the IRS, don't focus on the negative, focus on the solutions. With the IRS Solution Attorney, Darrin Mish. For over 15 years, he's been helping taxpayers with IRS problems reclaim their lives and their financial stability. Now, here's your host of the IRS Solution Attorney Show, Darrin Mish.
Good morning, and welcome to the IRS Solution Attorney Show. I'm your host, Darrin Mish, the IRS Solution Attorney. How you doing, Katrina?
Doing great. I'm your co-host, Katrina Madewell. Thank you for joining us this morning. If it's your first time ever joining us, I'd like to tell you a little bit about the show. So every week, Darrin and I show up on Thursday mornings, and we talk all about some of the things that you see in the field, these common things that seem normal to you, but for the customers that you're representing, it's the biggest problem they have in their life. You deal with a lot of non-filers, people that haven't filed tax returns in eons.
Absolutely. So, for whatever reason, I've dedicated my life to solving people's IRS problems. But that's the reason we don't call the show the IRS Problem Solver, is because we don't focus on the negative here. We focus on the solutions. But today, we've been doing this radio show for several months now. About 6 months?
And, maybe even close to a year. Time flies when you're having fun.
I have a really special announcement this morning, and that is that for the very first time, I know that my wife, Heather, is actually listening. I don't think she's listened to the show so far.
Oh.
And she and our assistant, Samantha, back in the office are listening this morning, so big shout-out to those guys.
Well, hi, Heather. Thanks for listening.
I'm actually more nervous than I've ever been doing the show.
You'll be fine.
But,
the topic for today, though, is right on time. So 15 red flags that could trigger an IRS audit.
Absolutely.
I don't know anybody that's not looking at their tax stuff now.
Back when I used to be a criminal defense attorney, I would meet people at cocktail parties, and eventually they'd ask me what kind of lawyer I was, and I'd say, well, I do criminal defense. And you could kind of see people slither away. They were like, oh, gross. Okay. But now,
according to Jim, they don't even talk to you.
Yeah,
Everybody avoids you.
But no, actually now, having done IRS, problem resolution kind of work for the last 16 years or so, almost everybody discreetly says, hey, can I get one of those business cards? Because you just never know. And that's why the topic of today's show is so important, really, is that really anybody who has to file a tax return could be subject to an audit, right? So that's why we're talking about it.
So what's number one on the list? Is this the biggest thing that you see, or is it just number one on the list?
It just happens to be number one on the list. The first one would be home-based businesses. More than ever, people are working from home now, and they want to take that home interest deduction, or the home business deduction. They want to figure out what square footage of their home is dedicated to business purposes, and then they want to, figure out that percentage and take off deduct the interest.
I had a home business many years ago, and I thought about doing that. Not only that, to take off a desk I bought for my home office, I got audited because of the desk.
Yeah, it does happen.
Don't home offices trigger an audit? Like, that's the whole point of this one? Because that's what I heard. Is that true?
I have a theory that they can, because it's heavily abused, and a lot of people remember they're saying, pigs get fat and hogs get slaughtered, and so people have a tendency to be kind of hoggish about what they deduct on their home, for the square footage and whatnot. I did have an audit on the home business deduction one time, and they were deducting. It was like a 3-bedroom home, and they were deducting the square footage of 2 bedrooms in the house, and I was a little skeptical at first. And then I had them take photos of the actual workspaces, and the workspaces were an absolute disaster. There was papers everywhere, but it was clear that people were working in that space because nobody would keep their house like that.
Right.
And
paper bomb everywhere.
Exactly. And when we went to the audit, the auditor's comment was, well, gee, I don't know if I can allow this. That workspace is pretty messy. And then I just kind of laughed and I said, well, I should send you a picture of my actual office at my office building, because it's not any better.
So home-based business compared to home office deduction, are they one and the same?
Yeah, it's one and the same. Is you just have to be careful.
Because home-based business, you think about the Mary Kay, the jewelry, and that kind of stuff. And you have people like me that have a real office and a home office, but I just don't take that home office deduction. Well, because I've always thought it would trigger just a migraine of an audit.
Yeah, and there could be distinctions. You could have a home-based business that was more of like a hobby. Give you an example. You bring in $5,000 worth of income, and you're trying to write off $10,000 worth of deductions. You're not going to get away with that very long, for very many years before the IRS says, hey, can we take a look at what you're doing here? Because it looks like you're writing off your lifestyle. It happens a lot in MLM, network marketing kind of businesses, like you mentioned, Mary Kay. And I'm not singling those people out.
This was what popped in my head.
Right, but they have a lot of travel. A lot of times they go to a lot of conventions and things like that. So you just want to make sure that
they go to the people's houses usually.
Yeah. Well, I mean, in terms of they're going to have a lot of travel because they're going to conventions where they get pumped up and so that they can recruit more members and stuff.
So the second one on the list is self-employment taxes. We've talked about this one a lot on the show.
Yeah, it happens quite a bit. If you're a Schedule C filer, and a Schedule C filer is just somebody who's self-employed, they get a 1099 instead of a W-2, so there's no automatic withholding. And one of the killers for being truly self-employed and filing on a Schedule C is that you have to pay your self-employment tax. I think Pat George here is our producer, and I think he probably gets a W-2, so he gets taxes withheld. He gets self-employment tax, or he gets FICA taxes withheld by the station, by the company that employs him, and then he matches half of that FICA as well. So it's 7.5 or 7.65%. The company pays 7.65% that the employee pays. But when you're self-employed, you actually have to match both halves, so it's 15.3% right off the top. And so that would be a pretty good argument for incorporating. And we don't really have time to talk about that on the show today, but you do see people who forget to file that Schedule SE, which stands for self-employment, when they file their tax return with their Schedule C.
Pat actually has several businesses, so I'm sure. Are you paying your self-employment tax?
Oh yeah,
Pat?
yeah. That's why every year I have to sell shares of my stock just to pay my taxes.
I'm going to buy some of those shares, I think.
I'm curious why self-employed people never. No, I shouldn't say never, but why a lot of self-employed people don't pay their taxes on time. And I think, for me, being self-employed for so long, like now I kind of got it down, but a lot of people, like their income fluctuates, and I think maybe they don't know, but they should still take that 15% and just.
Did you seriously just ask that question after doing the show for almost a year? The reason that self-employed people don't, pay their taxes on time is because there's no automatic mechanism to make it happen. Back before.
I know, but they know it's coming is what I'm saying. So why not pay it?
Because it's a negative thought, and so you don't want to deal with it.
Put it off as long as you can. You have to pay it then, and then just do it then.
Absolutely.
Is it self-discipline, I guess, as opposed to like your W-2, so they're just going to take it out?
Well, let me give you some historical perspective. Before about 1920, and I don't know if that's the exact date, but there was no automatic withholding from paychecks for people that were wage earners. So what happened is everybody in America who was liable to pay income tax just got a big bill at the end of the year or on April 15th. And so obviously there were some compliance problems and also if it's not forcibly withheld and you have to pay that big chunk, once a year, then it causes taxpayers to realize how high the tax rate actually is. Okay. So Congress decided, hey, we're going to go ahead and treat, 80% of the workforce, 80% of the population, just like lemmings. And we're going to go ahead and just take it out of their check, from forced withholding on the front end. And that way they won't realize how much money we're actually taking, how much money we're actually spending, and how high the tax burden actually is. But there's no real way to do that on the 1099 side because, the government can't get in the way of that self-employed person and their customers. So I think that's really the reason why self-employed people have so much trouble is because, again, like you said, it fluctuates and whatnot. So you have to set up some kind of discipline in order to get that done correctly. And we talk about real estate agents all the time. They should take out some reasonable percentage out of every closing and remit it to the IRS in the form of an estimated tax payment.
See, again, I don't pay myself like everyone. Everyone else in this business takes a commission. I take a salary.
Yeah.
And I do dividends.
Right. You take a salary and you have withholdings from your paycheck from your corporation, right? I think that's a more sophisticated
But I don't
approach.
even, I'm so disciplined, I don't even write myself a check without doing that online payment.
Yeah, that's great. I mean, that's absolutely the way that it ought to be done, but, it's kind of rare. I think that online payment is a good point in that I think it's only been a year or two that the IRS has had the ability for taxpayers to just log onto a website and pay by ACH or by credit card, like almost every other business has had for at least 10 or 15 years.
It makes a difference, though.
It does. It's actually easier, right? And it's psychologically, perhaps for some people, a little bit easier to just go ahead and pay it online than to write that check with all those zeros on it that you have to send in.
Absolutely, I would agree. So the third one on our list is work-related deductions.
Yeah, and this kind of dovetails into what I was talking about earlier with the travel-related stuff. If your work-related deductions are disproportionate to your income that you're bringing in, then you're probably going to get an audit, right? So if you, back to my example, if you had $100,000 in income and you have $120,000 in work-related deductions
every year,
year after year, it's probably going to be, a red flag for the IRS to go ahead and take a look to just see what's going on there.
Oh, man, I hear the music already. It's about that time. Number 4, just so you'll stick around throughout the break, is failure to file a tax return. It's a good one.
Yeah, a lot more common than most people know, right?
It gets it all the time. Darrin has a story after story where people haven't filed in 20 years, and it's amazing how you just, like Disney, poof, make it go away. You're listening to the IRS Solution Attorney Show with Darrin T. Mish. I'm your co-host, Katrina Madewell. We'll be back in a minute. If you're just chiming in with us, today's topic is 15 flags that could trigger an IRS audit. Pretty right on time for March.
Yeah, we better hurry up because we're on like number 4 and we don't have that much time today. So,
failure to file a tax return.
Yeah, this is actually really common. We call them non-filers in the business. My favorite story, I've shared this many times on the air, was a gentleman who came in. He was visibly trembling and shaking, and he came into the office, and he wanted some help with a tax problem. So we sat down, and I asked him what the problem was. He says, well, I haven't filed tax returns in a long time. I said, okay, that's fine. That's normal, or in my practice at least. How long has it been? He said, well, a long time. All right, I'm used to it. Hit me with it. He says, well, 1960 was the last time he had filed a tax return, and this is probably in 2010 or something like that. And so I actually got a big grin on my face, and I started laughing. But I wasn't laughing at him. I was laughing along with him because I knew that he would only need to file the last 6 years' returns to be considered current and caught up. And the irony was I was born after 1960. So we got him worked out, and it all got settled up, and he got to go on with his life. But actually, the failure to file a tax return can trigger an audit. It's called when the taxpayer doesn't file a tax return, the IRS can prepare something called a substitute for return, or an SFR. And what they do is that for self-employed people who get 1099s, this happens quite a bit. They just take the 1099, they add up all the 1099s, multiply times tax rate, no deductions, no expenses.
They've got the income.
And they've got the income side correct, and they go ahead and assess the tax against the taxpayer. And that's not a good thing.
If they do that, can that be amended?
You can file, you have the right to file a subsequent original tax return to reduce the liability, and we do that quite a bit. That's very common in our practice. But that is a type of audit, and it's not the kind of audit that most people want to go through.
So we talked about this one a little bit last week, but number 5 is claiming dependents and ex-spouse claims. This is a good one. Baby's mama.
Yeah, I was going to say that, but I
had to take it from you. Baby's mama.
I didn't think that was all that polite. What happens is when you have, a divorce situation or parents that aren't together, there's actually a race to file your tax return to claim the kids, and it doesn't matter really what the court order says with regard to who can claim the kids or not. The IRS is just going to go ahead and honor the first person who claims the kids.
Which I think is ridiculous because there's some just doing it every year.
Oh, yeah, I'm sure. There's people that run out there, it's probably January 2nd, and file their tax returns just so they can claim the kids. But, if you both claim the kids, then you're going to get some kind of audit because the second person that claims them is not going to be allowed. So
they're usually going to be the one with the trouble because they filed second?
There's one thing we haven't touched upon is that there's several kinds of audits. Right. So there's the audit that we all really fear, and that's the in-office audit, right? Where either they come to your office, which is really bad, or you go to their office, which is almost as bad, and you have to bring the big box of documents and the proof and substantiation and stuff. But there's also correspondence audits, and that's one of the things that we're touching on today is that, like in the case of claiming dependents that somebody else has already claimed, you're probably not going to get an in-person audit. You're going to get a correspondence audit. You're going to get a letter that says, do over, because you claim this child that you're not entitled to because somebody else already claimed them. You owe us X amount of tax. Do you agree or disagree? And then it kind of goes on from there.
How does that differ, though, from a regular audit? Because I didn't even know there was different types of audits.
A correspondence audit is usually limited to one issue, sometimes two. It's very limited to a single issue, so it's a little bit easier to deal with. The hardest audits are I forget the exact term, but it's basically where they just do a statistical audit because they want to see like every single thing that you claimed. And those are the hardest because
What triggers that one?
it's purely random, and they don't do them all the time. They only do them during certain periods of time. So they might have they do some audits of, and I've actually talked to people who've had these. I've never handled one, but you just get an audit notice that say, well, for purely statistical purposes, we're going to audit your entire return. And we want to see what's up. And what they do is they do, thousands of these across the country to see where the problem areas are, so they know
What to fix, what to change on their end.
what to fix and who to audit, more often. What types of taxpayers, for example.
So number 6 on our list for 15 red flags that could trigger an audit is medical expenses.
Yeah, you see this a lot because there's a limit to how much your medical expenses have to be before you can deduct those on a Schedule A. And medical expenses are an itemized deduction, and I believe that they have to exceed 10% of your adjusted gross income. So think about that. That's a pretty high number, right?
I think so, yeah. That'd be like you went to the hospital, car accident.
So if you earn $75,000 a year, that means your out-of-pocket medical expenses had to exceed $7,500 before you can itemize those and put them on your tax return. And that's relatively rare. So often what you'll see people that take, what the hospital billed them, but insurance paid some of that and things like that. So
that's what they're looking for, is to see what you actually paid?
Yeah, they're trying to see what is actually deductible.
All right, so number 7 on our list is omitting income. That never happens. Never happens. Omitting income.
If I had a nickel for every time a person said, I forgot to put a 1099 on my tax return.
And they send them late. We talked about that.
They do. But if you have some sort of system for calculating your income, system can be really simple, like all cash and checks get deposited into checking account, and then you can add up those at the end of the year. If you have some kind of even rudimentary system, you shouldn't have a problem with this. But it happens a lot where people, the 1099, they didn't get it, they lost it, they forgot about it, whatever. But we've talked about this in the past, and that is that the IRS is going to match what's on your tax return to the information returns that they receive on the other end. So the W-2s and the 1098s and the 1099s and all those things, they're going to match, the computer's going to automatically match that. So if you're a self-employed person and you're reporting, $50,000 income on a Schedule C, and the 1099s equal $60,000 in income, you're going to get audited 100% of the time, every single time. So this is one of those that you just can't.
Let's playing with fire. They're going to get the information, so you might as well make sure it's right.
Yeah, I mean, you're not going to get away with that one. You could probably get away from overstating expenses a lot easier than understating income that's reported to the IRS.
Right, because they already have the numbers.
Right.
Number 8 is charitable donations. Taking those deductions, right? The charitable donation deductions.
Yeah, these rules got tightened up in the last several years in that now we didn't used to have to prove our charitable donations. For example, you could just put cash in the collection, basket at church, and you could kind of just make up that number. But in the last, say, decade, the IRS has really tightened this up. And so then you're going to get those receipts, those statements at the end of the year from all your charitable organizations. And so one other area that I see that gets causes some audits is the donations to Salvation Army and Goodwill and things like that.
Yeah, that's what I was going to say. Because they don't usually put anything on that. We talked about that.
Yeah, so you're going to want to, if you're going to donate those items, first of all, I think you should donate those items that you're not going to use. I think it just makes a lot of sense. It's just the right thing to do. But if you're going to write that stuff off, you're going to want to write down on the receipt every single thing that you donated. So one dress shirt, value $6, for example. One sofa, value whatever, $65, whatever it is.
And you can look on their website and get an idea what something like that sells for.
Yeah, there's lots and lots of websites that can help you understand like the items that you donate, what they're worth. And I actually think that, this is kind of strange, but everybody has a camera in their pocket nowadays. Just take a picture of what you donated, especially if they're big items. A bag of clothes, I don't know if you're going to take pictures, but if you're going to donate
you donate a bunch of stuff,
a car, a boat, a sofa, a dresser, a bunch of furniture, things like that, you should take photos because you just never know, and it's easy to.
It's always better to have more documentation than not enough.
Yeah, my nightmare is when somebody comes in to the office and they want audit representation, and I look at the audit paperwork and I help them narrow down the issues. Okay, these are the things that the IRS wants to look at, and then I say, so tell me about your documents. And almost without fail, I hear the fire, flood, hurricane story. oh, I don't have any records to substantiate that stuff because they're gone.
So what happens in that case?
Well, I don't take a lot of those
We've never really
cases.
talked about that.
I don't take a lot of those cases because I only represent people who have realistic expectations, right? So if that's the story and they say, but I really don't owe any money and I want you to fight this all the way to the Supreme Court, you hear that a lot. You got to give me some bullets for the gun. And documents and proof, substantiation, are the bullets. So if you don't give me any bullets for the gun, I'm not going in to get my head kicked in because it's not a fun scenario, and you're not going to be happy later as a client.
Is there any rules, though, or anything? Like, let's say they did have a house fire and they can legitimately prove that insurance claim. Is there any rules within the IRS that would help them for that?
They are. Let's talk about that after the break. And things that can be substantiated even if you don't have the documentation.
Sounds great. You're listening to the IRS Solution Attorney Show. Today's topic is 15 red flags that could trigger an IRS audit. If we have time at the end of the break, we will take your calls. 888-404-1010. It would be the latter part of the show. 888-404-1010. We'll be back in a minute.
Are you suffering from IRS problems? Do you owe back taxes you can't pay? Is your paycheck or bank account being levied? Or maybe you haven't filed tax returns in years and simply don't know what to do. This is Darrin Mish to tell you that if you're tired of IRS problems hanging over your head and are ready for a fresh start, we may be able to help. Call the law offices of Darrin Mish at 888-GET-MISH, 888-GET-MISH. I can help you file old tax returns, work to release tax liens or stop wage levies, even negotiate deals to pay off back taxes at a discount, sometimes for pennies on the dollar. Hey, let's face it, these days it's not hard to get into tax trouble. A divorce, failed business, health problems, you name it. The point is, IRS problems may be solved if you're willing to take the first step. Call for a free consultation at 888-GET-MISH. That's 888-438-6474. Or go to the web at getirshelp.com, because the one sure thing is, IRS problems don't solve themselves. So get Mish. 888-438-6474. Principal Office, Tampa.
Welcome back. You're listening to the IRS Solution Attorney Show with Mr. Darrin Mish. I'm your co-host, Katrina Madewell. Today's topic is 15 red flags that could trigger an IRS audit.
So before the break, we were talking about things that that could be proven even if they weren't.
Well, we were talking about, like, if someone got a notice to get audited and they said, hey, can you help me? And I had a house fire. I don't have anything.
That's right. So, yeah.
And my question was, does the IRS take exception to that? Like, if you can prove, look, I've got an insurance claim, my house really did burn down, or I had a flood, I really have nothing.
In that case, I don't think you're going to have a dispute with the IRS that, the flood actually happened or that the fire actually happened, but you still run into the problem of, okay, how do we substantiate these deductions that you took? You don't get just a free pass. Oh, sorry, that's terrible. Your house is burnt down. Okay, we're going to just go with it, let the audit go. No, that's not how it works. I wish it did. That'd be great. But
well, that's what I was asking, if there's a provision in the law that allowed for that.
I think it would encourage arson, but...
You could have a very legitimate point on that one, Darrin.
Audit notice equals, house fire.
See, I have way too much paper already, so it all gets mailed off in that little blue envelope every month.
Yeah, exactly. So what happens is there's a rule called the Cohen rule, and it's named after a case that was decided back in the 30s. And basically it stands for the proposition that if you have expenses or deductions that are obviously part of your business or enterprise that you're engaged in, then you're going to be given some reasonable allowance even if you can't substantiate them. So let me give you an example. At my office, I have a standalone office building and the utilities are not included. And I obviously write off the electricity bill, right? Because without electricity, what happens? Well,
can't turn on the computer.
Yeah, we're sitting in the dark and it's either really hot or really cold in the conference room and we can't get anything done. And, everybody have to use pen and paper and it just wouldn't work, right? So obviously electricity for most businesses is going to be an expense that you're not going to have to prove, with any high degree of certainty that it happened because it's kind of obvious that it happened. And a real estate agent is going to be entitled to some mileage, right? Because you're going to have some showings. You're going to have some driving. You're probably not going to get what you claimed, but you're going to get something.
They don't look at consistency from one year to the next?
Maybe. That could be, a pretty good argument, but not necessarily.
It's all in the logistics, I'm sure.
Yeah, I mean, there's a lot of details that go on here, and so we're going to have, at that point, we would have the argument of, well, was the electric bill, $300 a month, or was it $500 a month?
Right.
And so the IRS is probably always going to come down on the lower end, and the taxpayer is always going to want to come out on the higher end.
Of course. And that's where you come in the middle, I suppose.
Yeah, and we try and get it worked out.
So number 9 is no health insurance. We talked about this with those lovely penalties.
Yeah, this is one of the newer things, right? I mean, this has only been a few years where you can actually get penalized if you don't have health care for the entire year.
So this now triggers an audit? Really?
Well, you could get a correspondence audit for sure that if you don't check the correct box on the tax return. This is the first year where you have to check the box, I believe. And if you don't have the correct documentation, I think it's a 1095 is the form that you get from your insurance company nowadays that says that you had coverage for the entire year. And I just love the name.
I don't think we got that.
I love the name that the government came up with. It's kind of Orwellian. They call it a shared responsibility payment.
And I can never remember that.
I'll never forget the very first time I saw a client's, basically their penalty notice from the IRS, and it said shared responsibility payment. I actually had to go ask somebody what the heck that was because I had never seen one. But it's becoming more and more common now.
Why wouldn't they name it something that would actually make sense, like no insurance penalty,
health care penalty would make sense.
Anything that makes sense other than shared responsibility. Number 10 is child support. How in the heck is that something that could trigger an audit?
Well, they're not deductible. So you see people deduct them,
really?
From their tax returns, and they're not deductible. So
yeah, you just get to deduct the kid.
You're right.
That's the idea.
I guess if you win the race to filing, right?
Win the race.
But really, the actual answer is you should go by the court order in the divorce in the family law case. You should go by whatever the judge declared in that case.
So number 11 is divorce settlements. That's tax deductible? Divorce settlements?
Well,
is that like we split the house or we split the car or we split something?
This happens a lot where, let's just go ahead and use a stereotypical example, right? Husband paying alimony to wife. Right. Well, husband might try to write off the alimony. Seems like something you should be able to write off, right? Because it's an expense and, it seems like a burden to pay the alimony. But no. You don't get to write the alimony off. The person receiving the alimony has to report that alimony as an income and has to pay tax.
That seems a little off, doesn't it?
Well, hey, talk to Congress. They're the people that pass these crazy laws.
So number 12 on our list is rental losses. That triggers an audit?
Well, sure, it could. If you have, what you see quite often is you have people who have a second home that's in like a vacation sort of locale, like Florida, for example, and it's near the beach, for example, and it doesn't ever get rented out because really they're declaring it a rental. Yeah, they're using it, as a second home, as a vacation destination, and they rent it out just a few days a year in order, to cause the Schedule E so that they can get the depreciation and the different repairs expense and things like that. And yeah, for sure. If you're not actually renting the house out on a regular basis, it may very well trigger an audit if you're, consistently showing losses year after year.
How does Airbnb play a role in that?
Well, with these new websites where you can kind of rent out, I don't know that much about it. I want to try it.
Airbnb is like, I'm going to rent a room in my house and you can come stay with me, almost like a bed and breakfast, but just in my house.
Yeah. I mean, with the advent of these travel sites where you're renting out your house or part of your house for just nights or weeks at a time, you're kind of in this hybrid kind of situation where is that a real rental or not? Is that really your house or is it a rental? What is that? And so the problem isn't in just having the Schedule E and reporting the income. The problem is where you're generating what look to be artificial losses from that rental activity. Does that make sense?
Yeah, it does.
Because, especially higher income people want to generate losses because they want to offset their legitimate income.
What if you have squatters next door and they come and take a bath in your hot tub? Can you write that off?
Where do you get this stuff at?
Well, I have a crazy neighborhood.
Random.
Did that actually happen?
All the time. I get up in the morning, there's squatters in my hot tub. And can you write that off?
I wouldn't know how to calculate the write-off. If it was a theft or casualty loss, like if they did damage, yes, you can write that off.
Can't you do it by numbers of how many? Because there's 3 or 4 sometimes.
That may bring up another whole point that Darrin doesn't like to talk about with me. I bring it up way too often.
I think what we need to do in that case, Pat, is we need to put a big no trespassing sign, in the backyard so that when they do show up, you can call the police and you can get them thrown in jail.
Lock on the hot tub.
Yeah.
Just some thoughts.
Yeah, like a locking cover would be good. Or don't do this, but sure would be funny. Corrosive liquid inside the hot tub. That would be kind of interesting.
That sounds like a lawsuit, Darrin. You're an attorney.
or just don't clean it, for a while.
Make it nasty.
Yeah, so that actually it looks fine, but there's all kinds of...
They didn't mind that.
Ew. I'm not even going to talk about about what could be in there. We're going to move along to number 13, which is commuting expenses.
All right. This is super, super common. I see it all the time. You can't actually write off your commuting expenses. So your drive from home to the office is not deductible. Your drive from the office to home
you're talking
is not
about
deductible.
W-2 employees or in general?
It's for
Everybody.
anybody. It's not deductible. So I have an office that has a fixed location, and I have a home that's a fixed location. From the drive from home to the office, not deductible. Now, if I drive from the office to the courthouse, that's deductible. And then there's kind of a cool rule. If I drive from the courthouse to home that day or on any day, then that is actually deductible. But your normal commuting, home to work, work to home.
So in the case of somebody like me, real estate agents, where we don't really need to leave unless we have to show a property.
Yeah,
deductible?
That's a little bit different. I would say that in a real estate agent's sort of example, that the drive from home to the broker's office, probably not deductible. That's probably more along the lines of commuting. So you probably have a weekly sales meeting that you're supposed to go to?
No, I don't. I have an office that's my office in Lutz, and it's 3 miles away.
Okay, so I would say that that's probably not deductible. But if you go show a house, you're in Lutz and you show a house in Tarpon Springs, well, for sure that is obviously not commuting. That's deductible because you don't have a real fixed location like most people do.
Right.
What about magazines?
Magazines.
You know, like magazines, like my wife's a hairdresser, and she gets these magazines that teach you how to do all that. Can you write those off?
Why wouldn't
for sure.
you?
Those are more along the lines of professional periodicals. But I'll give you an example. I get a lot of those professional sort of trade magazines, and those are written off. But, you know, the magazines that end up in my lobby, in my waiting area, so that you got like fishing and, you know, sport fishing and yachting and Marlin magazine, all that kind of stuff. No, I don't write those off. Those are not.
Really?
I don't write them off because I think that's a little aggressive. I think that you could make an argument.
So even if you never look at those and you're purely getting them for your clients, you don't write those off.
I literally never look at them. I don't have time. I wish I did. But I have stacks of really nice, good magazines about things that I'm interested out in the lobby. I'm sure, now come to think of it, there's not very many that appeal to the feminine side of people, so I might have to fix that. I might need to fix that.
Yeah, we'll have a Heather time in there on that one. Number 14 is stock sales.
Yeah, this is kind of a challenging thing to explain on the radio, but remember when you sell stock, you have to pay the tax on the capital gain. So how do you calculate the gain?
So if you buy a stock for $5, or let's do 100, you buy it for $100 and then you sell it for $125.
Well, then you have to pay tax on the $25 gain. So you have to keep track of that, you know, in excruciating detail too. And most people don't buy 100 shares of Microsoft at $100 and then sell 100 shares of Microsoft at 125. What do? Well, they buy 100 shares, they sell 35, then they buy another 75, and then they sell 85. I mean, it's kind of all over the place. So you're going to want to make sure you have really good records so that you can calculate what's called the basis. The basis in this instance is the purchase price of the stock, so that you can calculate that and pay only the tax on the gain.
That sounds extremely complex. Like that could be another whole job for somebody.
Well, yeah, you actually, when you get into the next trigger on here on
Number
our list
15,
is day trading. It kind of dovetails really nicely. Is that what these guys do? Is they buy 1,000 shares of something on a particular day, and they're going to try and be in and out of it in a particular day. This kind of lends me to that really good story that we have of the gentleman who owed $22 million due to day trading activity. And I think we probably ought to get to that one on the other side of this break that's coming up.
We will. We got a few more minutes, don't we? Yeah. We got a few more minutes. We had a question, though, so let's answer that real quick before we move on. Barry wants to know, he says, what does a flat tax mean? I hear politicians talking about it all the time, and I'm wondering if you can shed some light on what it is. Thanks. Love your show. Can't wait to catch it. Flat tax?
I think the flat tax is just referring to everybody paying the same rate. So if the flat tax was 15%, then it would just be 15% across the board for everybody, no matter what their income is.
And ironically, we did actually have a question from Jared, which is a day trader, and we'll have to answer that one after the break. You're listening to the IRS Solution Attorney Show with Mr. Darrin T. Mish, and I'm your co-host, Katrina Madewell. Today's topic, 15 flags that could trigger an audit. So watch out. If you missed the show, it's over on iTunes and everywhere else in a podcast, so catch the whole thing. We'll be back in a minute.
Welcome back to the IRS Solution Attorney Show. I'm your host, the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell. Thanks so much for sticking with us. Hopefully you brought some value to your tax return filing this year of the 15 things that can trigger an audit. And so Jared's question was right on time with number 15. And what his question is, I'm a day trader and I've been doing my taxes myself for a while now. Now that I'm starting to make a lot more money at it after listening to your show, I'm thinking I need to have a professional prepare them for me this year. Can you recommend someone in Tampa who can help me with this? Getting an audit is the last thing I want to happen.
Well, I can't believe I got that softball question. Yeah, you can call us at 888-GET-MISH. That's 888-438-6474. But, Jared, what you need to worry about in day trading is you really need to match those purchases to those sales, especially if you're dealing with the same stock over and over, or if you're not doing perfectly even trades. So let's say if you're buying 1,000 shares of GM and then you're selling 200 shares and then you're keeping 800 shares and then the next day you buy 375 shares and then you sell 600 shares, what happens is it turns into a mess. You literally need an Excel spreadsheet or something like that to match the purchases to the sales, and you have to be able to calculate the basis on everything. And remember, shares of the same kind of stock for the same company are fungible. How you like that word? Fungible means they're the same. They're like grain. They're like corn in a corn silo. You can't really tell which grain came from Farmer John's field or which grain came from Farmer Bob's field. So it creates problems where you have to be able to show and calculate what the basis is. And this leads me to one of my favorite stories. Was a day trader came into the office one time, and the IRS had prepared a substitute for return, and they had generated about a $23 million tax bill. We went back and matched all those trades for several years. It took over 40 hours of accounting and bookkeeping time.
Sure.
And in the end, we ended up generating a $50,000 refund for that client. So $22 million was what they owed. $50,000 was what they got back after we were done with them. So that was a pretty good result.
What's that word called?
Fungible.
Fungible. That's what I think I find in my hot tub.
I think that's fungi you're thinking about in the hot
Pat.
tub.
If you have a question, we might have a moment to answer at 888-404-1010, 888-404-1010.
So, yeah, it's really important that on the day trading and on the stock sales that you have the ability to match the sales to the purchases. It's about that time, isn't it?
That's the IRS train wreck of the week you just heard.
So, in this particular case, what had happened was an older lady came into the office, and she had a pretty good sized tax liability spread out over several years. And when I asked her, well, what caused you to owe the tax money? It's a very common question that I ask clients, because sometimes I can go back and kind of fix the problem at the source. She told me, well, I had a big 1099-C for cancellation of debt in this particular tax year. And I said, really? That's interesting. So how did that come about? She said, well, I don't really know. I had a first mortgage on my house, and I had a second mortgage or a home equity line of credit. I can't remember which it was. And she said, just out of the blue, I think it was Bank of America, just wrote it off. And I got a 1099-C. And then when I prepared my tax return, I had to pay the tax on that cancellation of debt, which is kind of crazy, but that's what the law is. And so she's like, so now I owe $29,000 for that tax year. I thought about it. I asked her a few more questions, and we were able to identify that she actually qualified for an exemption from paying the tax on that 1099-C cancellation of debt called qualified principal residence. So we went ahead and amended the tax return, and we took that tax off, and it reduced her tax bill by $26,000. And the IRS actually rejected the amended return. So now what? I mean, most taxpayers at this point go, that didn't work. We lose, and we're going to have to pay the bill. Well, I didn't like that answer for this particular taxpayer. So what I did is I went ahead and I appealed, or I went to the taxpayer advocate, and I just did a do-over. Basically, I explained in simpler terms this time what the situation was. And after about a year and a half, just this past week, we got the news from the IRS that they had written off that $26,000 of excess tax that she really wasn't liable for. And we were able to get that wrapped up for her. And so
the cancellation of debt, did she have a short sale, or was it one of the ones where they just wrote off the second sent her that?
I think she was probably behind,
right,
substantially behind on that second. And it seems like there's a trend right now with the lending institutions. They're just going ahead and writing those things off.
Well, there was a group. There was a group a while back, and there was something that passed for like a couple of the big name banks. I know this because we experienced it on short sales where they're like, oh, no, it got qualified in this group or the banks just basically wrote it off so they don't have to pay for it anymore.
Kind of sounds like another sweetheart deal for the bank, right? I mean, they get to write it off. They get to write off these bad debts off their balance sheet, so they look stronger, right? But then who gets stuck in the end? The same person that gets stuck in the end every single time. The taxpayer is going to get stuck in some of these cases just due to like ignorance of knowing what their obligations are. They're going to go ahead and pay tax on that cancellation of debt. And the IRS is not going to come out of their way and say, hey, wait. That was actually qualified principal residence, debt that you don't have to pay the tax on.
So how long did that case actually take?
That case took about 18 months. I mean, when she came into the office, I was thinking to myself, okay, this is almost as slam dunk as they come. This is going to take 3 to 6 months. Most of that's just going to be waiting time. But the IRS was kind of stubborn in this one. It took them quite a while to, eventually come around to my way of thinking.
Do they always let you do a do-over, or you just have to explain that the right way and see if you can get it?
Well, no, they don't always let you do a do-over.
That's what I'm asking.
And my philosophy in dealing with the IRS is I have to explain things extremely in an extremely simple manner. If one of my kids can understand my argument, then I have a good chance of winning. If it's overly complex, nobody at the government's going to listen. Nobody's going to read that stuff. Nobody's going to actually put any real thought into it. It has to be a slam dunk, very simple argument. And if you can do that, then you can win. And that's actually harder than it sounds. It's easy to keep things complex. It's much more difficult to, explain things in a simple way that people can understand that you win no matter what.
Well, it makes sense to me. The simpler, the better. And so that tax liability was like 20-some thousand?
It was like $29,000. We got it knocked down to about $3,000 at the end. So
what's the average time? Because I thought they all took a while after doing the show with you, but you're saying that some of them can be knocked out in 3 or 4 months?
Yeah, if it's a simple issue like an amended return is going to only probably take somewhere between 2 and 6 months for the IRS to go ahead and accept it and process it. In this case, since they denied the amended return, and you don't have a right to an accepted amended return, by the way. Everybody thinks you do, but absolutely you do not have a right to an amended return. That's why it's important to get that tax return filed correctly the first time, if at all possible.
We had so much fun with you today. The whole topic was 15 red flags that can trigger an audit. If you missed it, catch the whole thing on a podcast. This is the IRS Solution Attorney Show. I'm your co-host, Katrina Madewell, and Mr. Darrin Mish.
We're out.